Well, good afternoon, everyone, and thank you for joining us for the next superannuation update. Firstly, apologies for the delay in the presentation of this webinar. I actually had a cold last week, so my throat and nose and everything wasn't really conducive to doing a webinar. So hence why we're here today rather than last week. So what we're really going to be covering off is some of the changes that have happened recently in relation to superannuation, and also what's sort of coming and things you just need to be aware of, either for yourself or for your clients. So firstly, if we get looking at the general disclaimer that says that while I know what I'm talking about, you can't actually believe me, and that you should always ask for advice if you want something that's specific to your circumstances. So we're going to be looking at some legislative changes and regulatory update in relation to sort of what's been happening with our new Labor government. Talking about some changes that are coming around TBAR, or the transfer balance account reporting. A reminder around director IDs and the timeline that's quickly running out in relation to those. Just very quickly, we're going to touch on some non-arm's length income update, if you like, and then talking about some rulings that are coming in relation to some other things. So we will move on to those. So firstly, the important thing to remember is that whenever there's a change of government, when we hold an election, basically any legislation that was before Parliament is now gone. All right, so we can forget a lot of stuff that that we used to talk about that hadn't actually been passed. But the Labor government has come in, and they haven't really had a lot of time to get things moving, so to speak, as far as a legislative agenda. So really what we've seen is they've had a couple of sitting weeks. Parliament was actually suspended until this week because of the passing of Queen Elizabeth II. And after this week, then Parliament will resit in end of October, and that's going to be for our federal budget. So we're actually going to have another budget this year, because Labor essentially wanted to start putting their financial framework, if you like, around their legislative agenda. And then we will go back to having a normal budget cycle in May next year. So we're having two budgets this year. So this budget will really be setting out how Labor sees things going and where their spending priorities are going to sit. So this is actually a really important budget. You might remember that from the previous, when we do our regular budgetary updates, so the webinars were around when the budgets are issued, we sort of made a lot of emphasis on the fact that Labor would be, assuming they won at the time, would be coming in and doing their own budget. So that's happening, and we will actually be doing a webinar for that on the 26th, which is because budget's on the 25th from memory. So on the 26th, we'll be doing a webinar at that at 12 o'clock. So if you're interested in subscribing to that, look out for the messaging via the normal channels, and you can sign up to that webinar as well in a month's time. So what the government has actually got through is some legislation called the Treasury Laws Amendment to 2022 Measures Number 1 Bill 2022. Very catchy names they give these. So basically, this is now law. So it's gone through both houses, and it has received royal assent. The reason why I'm mentioning this is that it sort of fits a very narrow requirement for some people around the market-linked income streams and the reporting of those, and the asset test exemptions for Centrelink purposes and things like that. So if you have any clients that have market-linked pensions, it's worthwhile looking at what this actually means, this bill actually means. I'm not really going to go into detail here because really there are so few of them these days, market-linked pensions, that bore most people to tears. So, but just so you're aware that there has been some changes around that reporting requirements for market-linked. On the back of that, the ATO have also updated some guidance on market-linked pensions. So if you want to read those guidances, you just need to Google that Q code that I've got there. So that'll actually take you straight to the ATO's updated guidance on market-linked pensions. So basically, it's looking at the re-reporting of the market-linked pensions if they're wound up or restructured, and also what happens with events after 5th of April 2022. So just once again, just so you know what it means, so there's been that change on legislation and then the ATO guidance in relation to that. So if you have those clients, make sure that you check out those key codes, because there's some information there that you'll need to know. We've also got this legislation before Parliament at the moment. So it was introduced on the 3rd of August and it's had its second reading in the lower house, but it still hasn't gone to the upper house yet. So it hasn't gone to the Senate. Presumably that will happen this week now that Parliament's back in session. So this is measure number 2 bill. Now this one is definitely worthwhile for most people, simply because it removes the $250 non-deductible threshold for work-related self-education expenses. So before you couldn't claim the first $250 and you could after that. Well, this gets rid of that. So you can essentially claim it from $1. But more so in the superannuation space, the downsizer contribution is moving from age 60 down to age 55. Now, you might remember that we've only recently changed from age 65 to 60, or now we're going from 60 to 55. Now, this will come into effect, assuming it goes through the upper house okay, through the Senate okay with no changes. It will actually commence from the first quarter after receiving royal assent. So what that means is that if it receives royal assent in, say, October, it'll come into effect from 1st January next year. So any contracts that are entered into around that time, so basically, remember the contribution can be before the contribution time frame. So what I mean by that, let's say a contract was entered into on the 1st of December and they were 56 on the 1st of January. Because you're allowed 90 days to make that contribution, that downsizer contribution, they can wait until after the legislation becomes effective in January next year and then make the downsizer contribution. So the contribution has to be made when the relevant age is applicable. So if you're over 60, then you have to wait until you're age 60 before you can make the downsizer contribution. So it's not from contract date, it's when the contribution was done. So if this does happen to get through both parties or both houses this week, so in September, then we will see it happening from next year. So remember, 90 days, so almost any contracts from now will work, but you just need to just double check that. It's really interesting actually, because 20 years is a long time to run your downsizer contribution. And when I say 20 years, what I mean by that is that you can now make contributions, non-concessional contributions, subject to your transfer balance account balance, up until age 75. You only have to hold your principal place of residence for 10 years to qualify for a downsizer contribution. So if you happen to sell your home now at age 55, would you actually be better off using the downsizer contribution, or would you be better off using a non-concessional contribution to then potentially use the downsizer later on when you're closer to the sort of age 75, so another 10 years? Because this is a lifetime limit. The downsizer you can only use once, $300,000 per person, lifetime. So, and it's not subject to your account balance, your transfer balance account. So you might be better off actually doing a non-concessional this time at age 55 and then waiting to do a downsizer into the future, because it doesn't matter how much you have in super when you use the downsizer. So that's something you really need to, I suppose, consider, either in your own circumstances with your advisor, or if you're talking to clients, sort of explaining to them the rationales around the timing of contributions and the benefits of it, and if you should use it or not, essentially. And that's all obviously going to be very specific to the individual, because they might want to travel for the next 15 years. So then you might want to use the downsizer now. However, if they're looking to just buy another family home, then it might not be relevant. So it will depend on everyone's circumstances. Changes to the transfer balance account reporting. So this is more, I suppose, a preemptive strike, I suppose. So from 1 July next year, the transfer balance account reporting that we currently have will change. Now, as a bit of a refresher, transfer balance accounting reporting is where an event occurs that must be reported. So pension commencement, if there's a commutation of a pension, things like that, right? So they have to be reported to the tax office. Now, basically, if you have a super fund where a member has a balance of less than $1 million, you don't need to report it on a quarterly basis. You just do it on an annual basis. That's changing now. So every self-managed super fund will need to report on a quarterly basis. So that becomes really relevant for practitioners, because you have to think about how you're actually going to be able to produce the financial statements, or essentially financial statements, to be able to produce the balance so you can report it accurately to the tax office. So think about what that will mean for you and your business, being able to essentially produce balances on the by the 28th of October, for argument's sake, for the July through to September period, because that's really what it means. So it's going to be very difficult for the smaller practitioners to actually achieve that, more so because typically you won't have data, you might not have data feeds set up, or records are just a bit harder. You don't have processes built around how to do this stuff. So here at Vincent's, we actually have 2 people. All they do essentially is data processing, like bookkeeping, for all of our clients. So that way we're as up to date as we can be, should a client want to do something like start a pension. So it's relatively easy for us to determine those balances so we can do the reporting. Now, interesting thing to note is that there's actually a bit of a transition for the 2023 financial year that's actually going to be really hard for those smaller practitioners, where you're going from an annual reporting requirement through to what will now be a quarterly reporting. So essentially, any event that's unreported for the 2023 financial year will need to be reported by the 28th of October. Previously, you could wait potentially another 12 months, but that's changing. So any event for the 2023 year will have to be reported by the 28th of October. So if you've got a few clients that might be looking to start pension phase, you should be having those conversations with them, finding out who your critical ones are to keep up to date with, just to make sure that you can meet those deadline requirements, because obviously time will be pressing to try and get that information done. Because typically what will happen is a client will say, or an advisor will tell the client to start a pension on 1 July. So you need to have the 30 June balances prepared. Now, granted, you're going to have some time to prepare those accounts, because that won't be reported until 28 October. But you're still going to have to essentially have that fund prepared, balances determined for when those pensions start. So really think about your processes and how you're going to do that. Now, the ATO has also updated some guidelines in relation to this. So once again, search those QC codes on using Google, and that will come up with those information for the tax office around their guidelines and so forth around what it all means. So basically, when when events need to be reported, what events need to be reported, their case studies have been updated. So all of that is really relevant. So I suppose give it some thought as to how you're going to handle that as a practitioner with your with your clients that want to move to account-based. The hardest thing is more so if you're deploying the strategy where a client takes excess pensions, you've already got their determination that should they take excess pensions, that excess is taken as a lump sum. That's a commutation, so that needs to be reported. So if that happens in January, you need to report that in April, which obviously isn't part of the normal financial year cycle. So that's the hard thing to get right, is when you have mid-year events such as lump sum withdrawals. So it means you're going to have to really be monitoring what those transactions are inside your clients' accounts. I also thought it might be worthwhile just giving an update as to things that are on the ATO's radar, so to speak. So pending ATO guidance that's kicking around. So there was an old ruling, TR 2013/5, when a pension starts and stops, essentially. Very good publication, very worthwhile. Certainly of benefit to anyone. Have a read of it if you haven't already, if it's something that is of interest to you or for your clients. It's certainly it's a very simple publication and quite straightforward. The ATO had been trying to update this for a number of years now because of the 2016 budget changes, so transfer balance caps and all that sort of thing, because that hasn't happened yet. So they're hoping to do that early next year. So with all of these things, the reason why they get delayed is because of the pressures of those that produce these documents. Priorities jump over the top of them. You know, we all experience that, where something of more urgency becomes more urgent than what they're working on. So they're hoping to have that done by early 2023. So I'm sure it won't be anything too radical, but just something to keep in mind and to look out for next year sometime, hopefully. Rectification and education directions. So these are actually due to be issued next month. And really they're designed to provide guidance to the ATO about when the relevant matters should be considered around issuing a rectification direction or an education direction. So these give guidance to the staff at the tax office, but also they're very handy for practitioners to understand what the ATO are looking at when they are looking to issue a rectification direction or an education direction. So that way we just sort of have a better understanding of things. Also due later this year sometime is some ATO guidance in relation to when someone breaches the super rules, I'll say intentionally. So basically I'll call it not uncommon practice. I won't say common, but not uncommon, that if someone takes money out of super, rather than treating it as a loan that's going to be repaid, which is a breach of the legislation, you treat it as a lump sum benefit to the member. Now, technically, that doesn't comply with SIS. It's a breach under the payment standards. However, the ATO, through, I call it administrative ease, are happy to accept that as an approach, because when the money comes to the individual, assuming obviously, and I'm dealing with situations here where they haven't met a condition of release, so they're not really eligible for the money. So they've taken the money out of super. An administrative way to deal with it is to treat it as income to the member, and it's taxed at their normal marginal tax rates with no tax offset. So basically the tax officer said, look, we don't like the fact you've taken out of super. We don't like that you've done this, you've breached the SIS Act, but as a way to sort of make it a bit equal, we're going to tax you as if it's income to you. So that way the system isn't of detriment. So basically that's what that guidance is going to hopefully confirm. So the tax office have already said publicly that they're okay with that approach, but this guidance is going to essentially try and solidify that, or try and make it more codified a bit more, I suppose. So just bear in mind what that looks like when that is issued, because once again, it's a strategy that you can deploy for your clients to help them out should that be an issue for them. Non-arm's length expenditure. So this has been an issue that's been kicked down the road now for a little while. So essentially, it all started when back in 2019, the ATO issued some documentation that basically, draft ruling I think it was, that said that non-arm's length expenditure inside superannuation makes that asset that produces income, whether it be via actual statutory income, so like normal income like interest or dividends, or statutory income like a capital gain, makes that income subject to non-arm's length income provisions. If something is non-arm's length, if that income is non-arm's length income, it's taxed at top marginal tax rate plus Medicare, so 47% inside the super fund. So all it would take, for argument's sake, is me as an accountant using the resources of Vincent's to prepare my superannuation fund, and that is deemed to be non-arm's length expenditure if I do it and I don't charge the fund, or Vincent's doesn't charge the fund, because I've used the resources of the firm. And that then means that all income of the super fund is tainted, and all income is non-arm's length income. Now, before we had the last election, Jane Hume at the time, who was the Minister of Superannuation, basically said that this is not how the legislation was intended to work. So it's gone too far. So there was some legislation that was updated sort of around 2019, and that was like, this has gone too far. We don't want this. So the coalition government were going to change it. My understanding is that the federal Labor government also have the same view, that it's not the intention of how the legislation was meant to work, so they will also be looking to do something. So the ATO, I believe, has sought legal opinion internally. They've received a lot of feedback from the industry, and they're a bit of a bind, if you like, because their views differ to industry, and their views aren't exactly popular. And it's contentious, if I can put it that way, their interpretation of the law. So they're actually waiting for the government to make changes to the law, so then it makes their life easier. So this has actually been kicked down the road now since 2021, when the ATO issued their guidance based off the legislation that came into effect in 2019, I think it was. So for a couple of years now, the ATO have said we won't do any compliance action, or we won't allocate compliance resources to this action until certain dates. So every year it keeps on getting pushed out. So right now they've said until 2023 they won't devote any compliance resources to it. Now, basically, they're hoping that the government will produce some legislation in the next 12 months. That means that then the ATO can settle on a position that will be quite clear. Because I suppose the thing to remember is this doesn't just impact on self-managed super funds. This potentially can impact on the APRA funds just as well. And that's probably the scary part. For argument's sake, if they have someone who's managing a property for them, a big commercial property, and they get a discounted rate that's only for that super fund, then in theory that's non-arm's length income. So there's some nuances that need to be ironed through with it. So I'm expecting legislation to come in the next 12 months, And then from that, the ATO will perform up their position more finally, I suppose. And then it's also worthwhile noting that there's another ATO guidance coming out in October, in relation to interest in another entity. Now, this is basically to update the ATO IDs they put out, 2008/51 and 2008/52. So this is sort of dealing with shares and units inside super funds. So they want to really look at what constitutes an interest in another entity. And I've got the division there, 13.3a. So for those of you who may be aware, a super fund can invest in a related trust. So related party issues are one of the most complicated things we have inside super. So typically you're not allowed to invest in a related entity. However, you can invest into a related trust or company, provided that certain conditions are met. And one of those conditions is that trust cannot invest in another entity. So it can't do shares and it can't do units in another unit trust. It can't loan money out, it can't carry on a business, things like that. So it's restrictive in what it can do. In fact, more restrictive than what the super fund laws say for a super fund. But basically the ATO are forming up or finalising their guidance on what interest in another entity looks like to make that a little bit clearer for those trusts where a super fund invests into those trusts and then those trusts want to invest somewhere else. So that's what they're looking to do there. And then finally, the ATO are looking to issue some guidance once again in October. They must be busy around now, defining the term of employee. Now, once again, this isn't directly a super thing, but it has flow-on effects. So basically, there was a High Court decision in the Construction, Forest, Maritime, Mining and Energy Union versus Personal Contracting Proprietary Limited that sort of, I won't say redefined the term of employee, but it sort of changed it a little bit. So the ATO just wanted to issue some guidance around what that looks like, and also then update all of the rulings that they have issued around super guarantees and things like that. So once again, just something to be mindful of rather than anything else on that. I also just want to quickly mention around director IDs. So if you're a client of ours, you may have seen quite a bit of correspondence from us lately in relation to director IDs. When we send you out our financial statements for our super funds, if you have a corporate trustee, we include some information around that. We've also done a couple of mail outs in relation to it as well, because basically time is running out. So the way this works is that if you were a director of any company before 31 October 2021, you have to have a director ID by 30 November 2022. So you've still got 2 months, but given the fact that there's a lot of people still to get them, I would strongly suggest getting it sooner. If you become a director of a company today, for argument's sake, for the first time, you actually have to have your director ID beforehand. So essentially, even if a director resigned between 31 October 21 and now, and even if they don't intend on becoming a director again of a company, in theory, technically, they still need to have a director ID under the legislation. So if you're in that situation where you were a director but not now, still get one, because the penalties aren't insignificant, which I think I have over here. So $13,200 for non-compliance. So I would strongly suggest getting your director ID and getting it sorted. I know some of my clients have had problems in doing it because they don't necessarily have all of the ability to do it online like it's designed for. So you have to call them up. So that is obviously a longer process. So as you can see there, 61% of SMSF directors have not yet applied for their director ID. So only 39% have them. So that's a heck of a lot that still need them. So strongly encourage you or your clients to go and get them ASAP, basically. Interestingly, I've actually had a couple of situations where a client have said, oh, I've already got a director ID for this company. Do I need another one? The short answer to that is definitely no, because a director ID is like a tax file number or an ABN for an individual or a company. It's a unique identifier. So you only ever get one director ID, and having multiple is a little bit of a penalty. As you can see there, $27,000. So you don't want to get that wrong. And basically, directors must apply for director IDs themselves. So, I can't help my clients do it. They can be in the office here as we're doing it together, but I can't really do it for them because it's information that they have to do. So if you're doing it online with them, they need to have their phone for their MyGov ID to do it that way. So as painful as that is, because obviously we like to help our clients and try and do everything we can for them, sometimes we can't, and this is one of those situations. But obviously, if you need help with it, we've got some information on our website there, so you can see the link, or the ABRS website itself is actually quite good and helpful, or there's also a phone number you can call. Obviously, you can contact myself if you want to know more about it, or it's not really any tips, but if you just want some help with it, I'm happy to try and give you some guidance. But unfortunately, we can't do it for you like we could for a tax file number application. So just sort of bear that in mind. So you need to put some time aside. I had a client who had to phone them, and they were on the phone for 45 minutes. So you want to make sure that you've got all the information that's set out in that in our document on our website. It goes through all the identification documentation you'll need to provide or have in front of you at least. So make sure you have all that before you call them, if you do need to call them, or before you start going through the app process, because you'll need all that then as well. And finally, I just thought it might be worthwhile rounding out about what may be coming. So indexation of caps. As you may be aware, we've only recently just increased our caps to $27,500 for concessional contributions, $110 for non-concessional, and to 1.7 for the transfer balance cap, transfer balance cap. Now, the way the indexations work is that concessional caps is based off what's called a WATI, which is the average weekly ordinary time earnings. So the RBS report that data every 6 months. In December 21, that was $1,748 is the average weekly earnings of an Australian employee, full-time employee. If that happens to be $109, $1,908, I'll get it right soon, as at December 22 reporting, then the concessional contribution caps will actually increase for the 2024 financial year. So the end of 2023, 1 July 2024, it'll be $30,000. And I actually think that will happen. So that's my little bet, but we'll wait and see. Won't know until probably early January before we actually know what that looks like. Similarly with the transfer balance cap, except that's based off CPI, the Consumer Price Index. Now, the December quarter was 21.3, so it's worked out as a factor. If that's 23.7 or higher, then the transfer balance cap will actually increase to 1.8 million. So it's quite possible that we'll have both of these, particularly the transfer balance cap, will increase for the 2024 financial year, simply because of the way that inflation's going at the moment. Now, having said that, everyone has a personal transfer balance cap. So if you use it, if you start a pension, for argument's sake, whatever's left of your pension indexes up. So the remaining balance indexes up in proportion to the general transfer balance cap increase. Now, there has been some submissions going to the government around this next budget, talking about making that whole process a lot simpler, because it's a bit confusing for everyone in relation to where they're at with their transfer balance cap. So we'll see if that changes. It probably won't, because it's I would imagine, a low priority, particularly for this budget. But once again, just so you're aware that potentially the caps could increase for next financial year for both the concessional caps and the transfer balance caps, just the way that things are going at the moment. So you heard it here first. And with that, unless there are any questions, which I don't think there are, that's basically the end of anything that I was going to talk about. If you want to ask some questions around today's presentation or superannuation generally, you have my contact details there. And obviously our broader business advisory through either your normal advisor or through via the VinLink network. Feel free to reach out and ask questions of Vincent's. So if there's nothing else, then I think we might end it there. All right. Thanks very much, everyone. Hope you have a great day. See you later.